Thursday. Let's get the briefing underway. What I'm going to do today is I've got Sam available, so he's going to come on after I give kind of a bit of an overview, I guess, from a fundamental perspective, and then he can jump on the mic and talk you through a couple of kind of setups that worked pretty well yesterday that he was discussing with some of the live traders, and then his kind of thoughts about potential technical kind of price action that we might get for today's session. But first things first, looking at the charts, obviously we had an event yesterday evening, and if you made the decision to not stick around or look at your screens last night for the FOMC minutes, well, you didn't really miss a lot. As you can see from what the charts are telling you this morning, there was very little movement really on the back of it, certainly any sustained type of price action. Looking at the US 10-year on the bottom right, you can see there was a momentary move lower in the US 10-year, but recovered pretty much within the hour. Equities are pretty much unmoved, and in terms of the dollar, you can see there on the top left of my charts there was a little bit of a flurry in euro-dollar activity over a short time frame, but net we're pretty much exactly where we were. In summary, I would say it didn't really unveil anything particularly new that we weren't aware already. I would say really when you have one of the 4 key meetings throughout the year, so for the Fed, that being March, June, Sep, Dec, when you have the summary of economic projections and the press conference of Janet Yellen, essentially that means that you've had a kind of additional transparency in a kind of communication type strategy way, and so the minutes don't typically tend to create much new information. And certainly this came after June when we had the kind of full 3-part release from the Fed. But in summary, just having a quick look, the FT running the headline, the Fed ready to begin unwinding stimulus within months. The FT going along the lines that minutes of the June rate setting meeting showed that Fed were divided though over the exact timing of the move, with a number of officials suggesting they did not want to act any sooner than September, but several officials warned that allowing unemployment to fall too low could lead to the US economy overheating or the emergence of financial excesses. Actually, on that point of economy overheating, there's a really good game that I want to get you guys to play. That I had some of the trainees do the other day. It's by the Philadelphia Fed Central Bank, and it's called Chair the Fed. See if I can quickly find it here while I'm online. And essentially what it does is it allows you to adopt the position of becoming the Fed chair. And so if you play now, what it will do is it will play through a hypothetical scenario. So you start where you've just been appointed as the head of the Federal Reserve. You've got a benchmark interest rate at 4% to kick things off. It tells you here, so your green line is the interest rate. You've then got the blue line, which is your unemployment rate. And then you've got the natural unemployment rate defined by the dotted line. And then you've got your 2% inflation target, and you've got where inflation is currently residing in this hypothetical scenario at this present point. And then what you need to do is make decisions. So you've got 16 rounds, you hit go, and essentially the economy evolves, and then you need to make an interest rate decision upon different events that occur. Really interesting to see how well you guys do, and it'd be good to see how well you can govern an economic situation over the course of a year through your policy kind of understanding and thinking. So I highly recommend you give that a go if you get a second. I mention it because a lot of the guys were playing it yesterday, and what they had was unemployment was, in a sense, logically very low, very good, but it led to the economy overheating. And this is kind of what some of these Fed officials are indicating towards here, warning that unemployment to fall too low could lead to the economy overheating, the emergence of financial excesses. The other key part here with the actual Fed commentary from last night, though, was what they say about inflation. We know very much that that's the key economic data point in which Fed officials are basing a lot of their decision making upon. And the inflation takeaways were that most participants viewed the recent softness in these price data as largely reflecting idiosyncratic factors, including sharp declines in the price of wireless telephone services and prescription drugs, and they expected these developments to have little bearing on inflation over the medium run. So again, they're seeing this as kind of these one-off type items that have contributed to a slight decline away from target inflation, but over the medium term, inflation will move back in towards target. This is obviously what they're looking for technically to occur. The question is, will that actually play out in reality? I guess what they're arguing between the dichotomy of views is some are willing to wait and see, others are more prone to actually we're not in an environment where inflation is strong enough that we can be hiking. So this is where we currently sit at the moment. And this also does bring about the importance really of US economic data, because if inflation is or does appear to be moving away from target, the worst thing that can happen is on a day like today when you've got ADP, ISM non-manufacturing, then you get non-farm payrolls. Yes, these aren't as important as inflation, I'd say, at this particular point in time, but if they start to soften as well, like what we've seen with soft data coming off its best levels, then what this might create is more nervousness about other areas in the economy and the forward-looking future and health of the US economy. And then you might start to get this slightly more cautious again and gradual approach from the Fed in what we saw last week was this kind of global coordinated move towards more hawkishness. So certainly data does start to pick up a bit more of importance going forward. But overall, I would say not too much really to speak of. Status quo. We continue to monitor Fed speak and economic data accordingly going forward. Other data from overnight, and this was significant because let me just go back to the crude oil chart, and Sam's going to talk about this in more detail, but I just want to bring the chart out a bit further here because this is what we were looking at yesterday. And yesterday we had a really big down day for crude oil, certainly in comparison to this very strong recovery that we had from the big downtick post OPEC meeting and kind of disappointment about they made the extension but didn't go any further, and US output going up and so on and so forth. We had this really strong rally, and wasn't really one specific catalyst for the sell-off yesterday. A few people obviously pinning certain items to the move, such as we had Russia. We spoke about, I think in the briefing yesterday, oil had almost recovered to a point where Russia government officials felt comfortable enough to say, do you know what, we don't need any more action, we don't definitely need to cut and make any deeper production cuts than the ones that already exist. Almost acted as if, okay, right, now's the time then to take some profit on these longs and the price to fall lower. So you had some Russian comments. You also had a Reuters report suggesting that OPEC exports were up in the previous month, the month of June. And then this idea, of course, that obviously we'd appreciated in the price of oil so quickly over a short period of time that there was an idea of some profit taking, because ultimately, irrespective of the fact that US output did decline 1% last week, it is still tracking at a very high level, and US rigs, yes, we saw the first decrease in rigs for the first time in 24 weeks last week, but ultimately it's still an upward trend overall. So there's definitely I would say a top to where oil can go given those circumstances. So a bit was taken off the table yesterday. So largely I think more profit taking. But looking at the oil numbers, if we start to drill into the oil price activity a bit more closely here, I mean, this is, let's put it on a 30-minute chart. This was yesterday's session, and then we've had quite a decent move here last night, shortly after 9:30. Obviously, we had the Independence Day holiday, so the API crude oil inventory numbers a day later than normal, and this was the timing of it. We grinded back down lower during the first part of the Asia-Pacific session, but as soon as Europe's come back in, we've had another push on the upside. I guess on the upside, resistance-wise, the nearest target here is pivot. 45.81, we've just shy of that in the initial response to the APIs last night, and then as we've come in this morning, it's trading just sub that level. The numbers then, API crude was a drawdown of 5.764 million. Expectations were for a drawdown of just 2.5 million. So it's almost kind of 3 times deeper, if you like, or certainly well over 2 times deeper drawdown. It was the biggest draw since 2016. Gasoline was a drawdown of 5.7 million. That gasoline draw was the most in 4 months. So particularly large drawdowns in crude and gasoline. Cushing, also a draw of 1.4 million. I would say in terms of the kind of range in which Cushing tends to fluctuate, that's a fairly significant drawdown as well, and distillates was a build of 375,000. So overall, it was deemed a particularly bullish report, hence you had a pretty decent move overnight, and we pulled back from the lows that were seen, what typically would have been the historical NYMEX pick close time when we were trading just sub a 45 handle, and we've recovered pretty much 70 cents from that point to where we trade in this European morning thus far. And so, as per usual, that'll be your kind of forecasts then to base around market positioning for the Department of Energy report we'll get later on this afternoon. Don't forget, because of the US holiday, that report is at 4 p.m, not 3:30, which is always the case post a holiday. Having a look at what we've had this morning, has been some economic data coming out of Germany, but otherwise the economic calendar for the morning in Europe is relatively quiet. You've had German factory orders, came in at 1%. That was actually below expectations, which was for 2%. Has this had much of an impact on the market? No, not really. I mean, in terms of the fluctuation, again, with this data set, it tends to be fairly whipsaw. You can see we've had a range really in the last 12 months of kind of +6 to -7. So this is nothing, I'd say, although it was weaker by 1%, it was nothing to really be classified as an outlier, I guess, that would equate to underlying movement in the market. Looking ahead then, in terms of the calendar, as I said, the morning is relatively quiet. One thing that we do have is ECB minutes. Now, they've got it highlighted here. Historically, ECB minutes tend to be fairly dull. That's because, unlike the strategy of communication from the Bank of England and the Fed, which have their kind of quarterly reports or quarterly inflation report in the case of the BOE, the ECB have a press conference with every meeting. And so what that allows the President, Mario Draghi, to do is to convey with more clarity or transparency, I should say, with the financial markets and the media and attending press, what it is that he tries to convey through the statement issued from the ECB on the rolling months. So the ECB minutes tend to be very much so just a repetition of what we've already heard from Draghi. But just given some of the discussions ongoing at the moment, the emphasis on inflation, the potential policy tweaks we could get in towards, you know, the context of the ECB sounding more hawkish over the last week or so, I think actually these ECB minutes could be quite interesting. And I think that my advice probably would be not to be in an open position in the DAX or the Euro, and as such in European assets, upon the release of that information, which we'll get at 12:30. There is a tail risk that something quite interesting could materialise out of that. Looking into the US afternoon, that's when things get a little bit more interesting from a calendar perspective. You've got the ADP employment change. For any of the kind of interns, this is one of the more important data points that we generally get on a month-to-month rolling basis from the US, because this is seen historically as a precursor for the Bureau of Labor Statistics labor report we get on Friday, which is US non-farm payrolls. Interesting thing about ADP and payrolls from last month, if you can remember, was that ADP last month was a fantastic number. 253,000, way above expectations of 185,000. What that typically leads the market's positioning to do is to then expect that non-farm payrolls will be, in a similar fashion, a fairly robust report. You're measuring a large portion of the private sector. That tends to be a good kind of sentiment feeling for then how the broader report will come out on Friday. In this instance, though, although we recovered quite robustly in May from April and ADP, and it was much higher than expected, as you well know, non-farm payrolls came in at 138,000 last time. So you had a big divergence appear in what otherwise tends to be a fairly correlated piece of economic data. So whether or not people want to buy into ADP too much this time, just given it's fresh in mind that there was a breakdown quite severely in those indicators last month, is kind of yet to be seen. From a trading execution point of view, if you are looking at ADP, the one thing to be very careful of is the way in which it's released. It's not just a one number, the revision is also very important. And the reason why on an execution basis this is quite unique is because the initial headline number for ADP gets released immediately, but it actually takes anything from a few seconds for the revision to become available. What you tend to see then is an initial knee-jerk reaction to the first release, but then there's a risk that the revision could be the opposite direction, and then you'd get quite a severe pullback in the market. So the more prudent approach is you're not going to be able to beat a kind of high frequency type that fast blip money move or fast money move action that you get in the market. Better to just wait. Let's assess when you get the full report released, and then you'll see the move thereafter if it is out of line enough away from consensus. Otherwise, other data points for the day from a US perspective, you've got the weekly jobless claims, so usual drill with those. I would say that typically these aren't and haven't been for a while particularly interesting, given that they're fairly constant and in a reflective of a fairly healthy employment situation in the US. And then you've got the ISM non-manufacturing PMI. Quick look at what that looks like at the moment. It's been fairly consistent. Last month production new orders rose at a slower pace, but unemployment did pick up in terms of the constituents on the breakdown. That's always the important thing to recognize with these ISM reports for manufacturing and non-manufacturing. It's not just the headline kind of composite figure. Don't forget you have the various constituents of particular interest, being the employment one, because again this adds as another piece of the puzzle to give you an overall better understanding of what the employment picture was for the previous month, and that's what we'll get in non-farm payrolls on Friday. And then you've got the Department of Energy crude oil inventory numbers at 4 o'clock later, as we mentioned. Speakers, you got Fed's Williams. Should have been speaking while I've been covering this briefing, but haven't seen anything as yet. So maybe just keep an ear out for that. And then you've got ECB's Pratt later, and Fed's Powell this afternoon. Powell may be of interest, speaking on housing reform, but just because Powell is a voter, obviously, and coming on the coattails of the minutes, which were in a sense dated, might be interested to see whether or not Jerome Powell feels the need to kind of update with the response with some more details post that event. Okay guys, going to hand you over to Sam, let him talk over a couple of charts and some trade setups for the day. So have a good one, and I'll see you later on in the chat room. Thank you.
Yeah, so we were talking, it was probably about midday yesterday, about the solid support we have. Let me just make this a bit bigger. In both gold and T-notes. So gold came back and tested its previous low, which if I just make this chart on a longer time frame and make it a bit smaller, you can see how well, doesn't want to show up. Oh yeah, here we go. How well it's held, and since then it's sort of bounced quite nicely. I know today just now just creeping below the pivot, but that and T-notes as well. If we mark up the low in T-notes here, lower the time frame and just scoot back a bit, you can see how well that area in T-notes is held. And of course the euro. So since those lows have been made, and with not much happening overnight with the minutes, it might well be that we've sort of found a good level of support for now. With the US data today and tomorrow, it may well be that we could break through there. So definitely levels to be marking on, and probably the most important levels to the downside for those charts. that I would consider. The other key market to look at today, albeit in the afternoon, will be, of course, oil, following the bullish release last night. Since that happened, we've been sort of going sideways in this range, pivot holding for now, so definitely worth marking up the pivot, and then the low that we had this morning, let's say the low of the morning around 45.20. I wouldn't be surprised if we sort of stay within that range. Always a bit risky anyway, trading oil before the 3:30 release. I think if you were going to get stuck in, you'd want a bit more conviction, preferring maybe the classic kind of trade, wait for it to actually break out before going too aggressively. So oil, I think, will be the focus for later on in the afternoon, around 4 o'clock instead of obviously the 3:30 time, to be looking at. Euro, as mentioned just a minute ago, that low that held so well, got to be marking that level up. If I just scroll back and show you where that came from, well, you can see just on the left here. I don't want to just move it over, you won't be able to see because of the camera, but right here, and yesterday's S2 held really well, so definitely worth keeping that on. You know, we have been trending down for the last couple of days, but in both Euro, T-notes and gold, strongly holding, and with the DAX and the Bund on their sort of lows this morning, it sort of supported the Euro, so worth keeping an eye on the level I have marked up from yesterday evening's high up here. If we can break through there, then obviously you've got the previous highs up to R1 to contend with. But anything around this pivot now, if we get back into this area, I'm just going to square up. It looks quite messy. Probably best just to sort of stay out of that until the data comes and sort of go from there. The pound, if I just do it on this chart and have a look where we're at, again you can see kind of messy this morning around the pivot, so probably better off just looking at, you know, the key areas. You've got below here S1, yesterday's low, and you've got some nice levels around today's R1 that we're sort of range bound within, so probably better off waiting for you know, some more momentum to come into this market before wanting to really commit to it. If we have a look at Aussie dollar, because as we were speaking around midday, its previous low was holding quite well, and then we had let me just make this chart a bit bigger. We did end up breaking through, but only, albeit quite briefly, and then if we actually did, and at the time we did look back, we saw there was some further support around this area. Didn't quite make it down to it, as you see here. I know that's quite small, but again, holding quite well. So it's going to take a bit for these support levels to break on through, whether it be, you know, some strong dollar data to come over today or tomorrow. But for now, they're holding. But I would have all these lines definitely marked up on the chart the whole way, and sort of plan how you're going to go about it if they were to break. So, you know, purely looking, if we just switch back to that euro, if we were to break through the level marked up, let me just make sure I've got it pretty much bang on. You can see this whole sort of area is going to be key resistance, and even that spike down that we had here. So even a breakthrough here is going to take a bit, and that's what I'm saying. It might be a strong data release that does get us through there. If we can, then there is a bit of free room to go, and we can start, you know, looking down towards S2 and then beyond, and then suddenly you start looking at 113 and the previous highs from this double top here on the 19th and the 26th. So I'd be aware that just because we break through yesterday's low doesn't necessarily mean the door's going to open, and that's similar for both gold and T-notes as well. There is a couple of half decent levels around that area, but if it goes, it will sort of open up. So for the day ahead, I'd obviously be aware midday for anything euro related, worth having a look into the DAX and Euro stocks, which are both just contained at the moment. If we go to the DAX, you can see really, well, let me just get a rectangle here. It's kind of stuck within this range here. And Euro stocks, if I just go over as well, you can see pretty much exactly the same. So albeit this morning moving down to their lows, which is obviously helping support the euro, you know, you're not really going to want to jump into a trade too eagerly right now. To the upside, you can see there's a bit of open air to go here, and to the downside as well, back down to the low we had at the end of last month. US equities, S&P looks pretty similar, doesn't it? You can see if you were to get that rectangle there, it's very range bound. The Dow Jones as well, yesterday holding well. I know the Strat I think worked quite well yesterday with the S&P. So you can see the markets are kind of just ranging along. So that should almost be your first go-to trade idea here. Find the direction that we've got to this range and try go with that. Of course, back in your mind thinking how to play it if we do break out, but what are the reasons that we're gonna get ourselves in that situation? Probably going to be quite strong data today or tomorrow. Other than that, it may well be that, you know, for the markets we initially talked about, they're going to hold quite well. So data out quite a lot in the afternoon tomorrow. Watch out for oil, as you don't really want to commit to it too eagerly ahead of that release at 4 o'clock, which will be interesting to trade. Of course, the easiest trade for that will be a complete conflict to the 9:30 release last night, and then we could obviously undo that move and more. But ahead of that, keep an eye on these levels, equities ranging. But any questions about any of these charts, do put them in the chat, as I'll be logging in. Thank you. Have a good day.